Good morning, everybody. Welcome back to the Opportunistic Trader. It is October 18th, and it is Thursday, October 18th, and we're going to be joined by Dave Floyd of Aspen Trading. He's been joining us recently, talking about technical analysis, Elliott waves, taking us through the different markets he focuses on, and a number of different interesting signals. A lot of great technical indicators he focuses on. So he kind of takes us through, sharing his screen, what he's looking at the moment. And so Dave is going to be joining us any second now. Before he comes on, just once again giving you an update. S&P is down 13, S&P futures down 13, NASDAQ futures down 78. Dollar is slightly higher on the day, but not a big mover. And U.S. yields continue to trade higher. We're about 321 in the 10-year, so we're keeping a close eye on that. So Dave, you can hear me if you can take it from there.
Good morning, everybody. David Floyd here, as Mike had indicated. The last time I was on here was probably about a week and a half or so ago, and obviously since then we've had this big sell-off in the S&Ps. And I think what's worth noting on the S&Ps, and again, oftentimes not everything that you look at is a timing indicator, but there can certainly be, from a technical standpoint, telltale signs of what might be happening in the market, or let's say more importantly, what might not be happening in the market from a technical perspective. And what I want to do is I'm just going to kind of go back in time here prior to this sell-off. And again, I wasn't short the S&P, so I'm not trying to go back and rewrite history here, but I can say that myself and several of my colleagues were kind of looking at this last leg higher in the S&P since August, and kind of wondering what on earth this really was, because at least from an Elliott wave perspective, it wasn't really what you would consider the classic impulsive five-wave series of moves, which is indicative of an uptrend or a downtrend for that matter. But obviously, since we're trending higher in the S&Ps, you want to see five-wave moves. We obviously did not have that. We had a lot of three-wave moves, and in fact, one colleague of mine called them the funky threes. And again, that does put you on alert. Again, trying to time it, I don't think would have been terribly practical, because you could have made, you might have been able to catch something in here. But again, not everything you can time perfectly. But I think the market was giving us some signs, at least technically speaking, that there was some weakness, or at least the price action wasn't concurring with what was happening in the market. And then of course we had this big sell-off. And of course the question now that everybody's asking is, now what? And I'm going to be completely honest. I think now what, meaning over the next few days, I think it's anybody's guess. I think we could have some serious runs higher. We could have some serious runs lower. I still think things are shaking out. How you see the chart labeled here is truly how I'm looking at the market. It's my interpretation of what we have right here. It's very possible that we've kind of completed this correction off of last week's lows. Typically a wave B correction will stall into the 50 to 60% retracement of that initial leg lower. Again, not trying to trade on that at this point in time, just trying to gauge what's happening. I'm not trying to get in there. Now, if you're doing some short-term trading, no doubt there's opportunities in here. I won't deny that. And trust me, I've had my fair share of little stabs at the market in the last week. However, I would say that if you're trying to position yourself over the next couple of days, unless you got really wide stops, that's going to be pretty tricky, at least in my opinion. What I'm trying to measure up here is how far does this move go higher, or is it completed? Because I'm thinking that based on the way I'm interpreting the charts, last week's break lower is pretty key. It does suggest that there's lower levels in the days and weeks ahead. At least that's how I'm viewing it. It's really easy as a trader to sometimes get caught up and be reactionary to the market. Very easy to do. We all slip in and out of that at times because we're human beings. But I think you have to, at some point, regardless of your time frame, you got to kind of come up with a narrative or a thesis and go with that, whether you're wrong or right. And the thesis that I'm leaning towards at this point in time, but waiting a little bit more clarity, is that I think we're going to be moving lower. I do really think that 2860, in fact, let me label my chart accordingly. I would say 2860 to 2880 is kind of my invalidation zone. If prices manage to move back above there and hold, and that's the key thing, just because they touch it and maybe, you know, screw around up there doesn't necessarily mean that the bet is off. But that level to me represents a cap on the near-term price action. So I'm basically saying that as the dust continues to settle here, I'm fully expecting prices to move lower. In fact, I would say that the next 100 to 150 S&P points are to the downside, not to the upside. Now, do I have a position on to reflect that right now? No, I do not. But what I might start doing, depending on how price action unfolds over the next several hours, or maybe into tomorrow and into, well, actually tomorrow is Friday, into the end of the week, you know, I might start either selling S&P futures. I might maybe sell some call spreads or buy some put spreads on the futures or the spiders. But I'm walking into today, into this, you know, webcast with you folks as saying, I'm bearish on the market. I haven't expressed it yet, but that's my thesis. That's my game plan right now.
So Dave, can you hear me?
Yeah.
So the question is, what would it take for you? What signals would you need to see? What sort of breakdown level would you need to see for you to become bearish? Or to actually, I'm sorry, not to become bearish because you are bearish, but to actually put a position on that side.
Yeah. Well, it's a great question, Mike. And sometimes there's not a simple checkbox answer, like if this happens, then that, or if this happens, then this. A lot of it will really boil down to how price action unfolds. Now, if we go below, let's say this level right here, which was yesterday's low, 2780, 2785, that to me would be pretty key because it does two things. One, it takes out yesterday's low, but more importantly, it creates overlap of that initial move higher. We had this B wave correction. And whether you label this as an A or a B or a C, it doesn't really matter. Anybody with some basic technical analysis skills can clearly see that we have the market moving in, you know, a three-wave pattern, or let's say a three drives higher, whatever the hell you want to call it. It doesn't really matter. And when you get overlap, that indicates to me that the price action to the upside in this case is corrective. So for me, 2785, if we got a New York close below that, that would be indicative of something that might be brewing to the downside. But to be honest, I can't put something on my screen right now that says, if this happens, I'm bearish. It's going to be a combination of factors, but that would probably be the most obvious one. And even if that happens, that doesn't necessarily mean I'm going to dive into the pool. I'm actually going to start looking to nibble, because the fact of the matter is the buy the dip mentality is still alive and well in this market. And I'm not saying that's wrong. I'm just saying that's the way it is.
Right.
But I'm just, for the time being, my thesis is to the downside.
Right. So now my question would be, if you did enter a short position at whatever level, whether it be here or 20 points lower, what sort of stop out would you use? Where would you say, okay, you know what, this is another buy the dip, they took it back higher? You know, is it yesterday's high 2820? Is it, you know, above last week's high somewhere? You know, what sort of level on the charts are you looking at there?
Well, there's two ways to that, and I can be pretty objective about this. Under the scenario, let's say I'm going to sell the break below this 2785 area, that overlap level. If I sell that break, I think you've got to be pretty realistic of 2823, which is yesterday's high, or using yesterday's high as your stop loss. If I'm going to be, let's say we get one more little push higher into this 2840 level, then my stop loss has to go into this 2860, 2880 area. So it's going to depend on the scenario. If I'm going to sell the break lower, obviously my stop loss can be much lower than that, because then this point becomes far more relevant. But if I'm going to sell a rally, which again, I'm not ruling out, this to me doesn't necessarily look as though it has the impulsive qualities to the downside. So if the market were to squirt a little higher right here and I decided to sell into this area, then my stop loss level becomes, let's say, that 2860, 2880 area. And at that point, your stop loss isn't necessarily a a hard number. It's kind of how do prices react and trade in this area. And again, I know there's probably some people on the call that want a clear cut black and white answer. Sometimes there isn't a black and white answer. And the quicker you get your head around that, the quicker you'll develop as a trader.
Sure.
So that's how I'm framing the S&Ps. Now, the logical flip side to that is, okay, if you're bearish the S&Ps, presumably you might be long treasury notes. And the fact is, yes, I like treasury notes in here. They've been beaten up really bad. And this is the 10-year note right here. This is how I'm viewing it technically. Got a small position on from last night, 117.26. It looks as though we're moving higher. So if the S&Ps move lower, presumably the treasury notes would move higher, although that wasn't the case last week when we had that big sell-off in the market. But if I'm correct, and we start to get a decent push lower in the S&Ps of 100 or so handles, then it's reasonable to expect treasury notes to head up around towards 118.26, which is simply a measured move of this move higher, projected from what I'm calling the end of the corrective wave in wave B. Stops right now are at 117.13.5, so a pretty tight stop loss. If as prices begin to move higher, assuming they do, I'll probably ratchet up the stops to break even or right here at this wave B low. So, from a big market perspective, when I say big market, meaning the big asset classes, bearish S&Ps, bullish treasury notes. I don't have a position on the S&Ps, but I do have a long in the treasury notes. I just like the way those trade better. I'm not worried about getting zigged and zagged around because they tend to be much more methodical, whereas the S&Ps tend to be manic, ADHD-like qualities. So until I get some clarity on where the S&Ps are going, I'd prefer to kind of dip my toe in the water vis-a-vis treasury notes. And then once I get some clarity on the S&Ps, add a position there to kind of really get more of that, that alpha, so to speak. So again, that's the way I'm viewing the big market at this point in time. There are some interesting trades that we have going in the currency market. For the most part, I'm not trading in any of the major pairs right now. We have positions in, we're short Aussie Kiwi dollar, which is obviously not one of the most popular crosses, but again, technically speaking, it's got a really robust setup. We shorted this into the spike higher last night. The overall premise here is pretty simple. If we look at a longer term chart, in fact, I'm looking at a weekly chart here. Let me get rid of this just to declutter it a little bit. I'm looking at basically a very long-term completion of a sideways, or what you would call an Elliott wave, a triangle pattern. That completed based on my analysis back in August. We started to move lower, therefore moves from a triangle tend to be not only sharp and decisive overall, but they tend to be terminal. Terminal in this case might mean, many months out. I don't think we'll be in the trade quite that long, but the bottom line is this is the backdrop for the trade. A completion of a triangle, which is a corrective pattern, which then leads to the resumption of the overall trend, which prior to that was down. So we are short from about the 108.80 level from last night, and we're starting to move lower. And again, this is not a trade where I'm going to be gone tomorrow, unless, of course, we get stopped out, but my stop's way up here. But this is a trade that we might milk for, hopefully a few weeks.
What sort of profit target range are you looking for here?
Oh, on this one, again, under ideal conditions, if we're lucky, we might get this thing down to 102. It all depends on what happens. In an ideal scenario, prices will just continue to drip lower, and we'll never feel as though we're threatened by a spike higher, and we'll happily take our profits at 102. Whether or not that plays out, that remains to be seen. But that's how I would, potentially see it. Right now, I'm putting my stops at 110.20 because anything above this level invalidates what this current pattern is now telling me.
Gotcha. Now, when you look at these trades, is it anything fundamental with it, or is it purely technical looking at the charts?
In this particular one, it's completely technical. I couldn't tell you. I mean, yes, I can tell you the difference between the Aussie and Kiwi economies. I could tell you maybe some slight interest rate differentials, but it has zero bearing in this particular instance as to why I'm short. Nothing.
Okay, great.
The other one that I'm looking at is, again, not necessarily a mainstream pair, and I maybe trade it once or twice a year. This happens to be maybe the second time I've traded it this year, is dollar Mexico or dollar peso. We are long. We got long yesterday afternoon. I told clients about it again this morning. Again, very simple type of situation here. We had a 5-wave move lower in wave 1. We're correcting in wave 2. Wave 2 presumably should go up to about 20 or higher. Therefore, we've got plenty of room to work with the upside, and relative to a stop loss of here of 1873, the reward to risk is, really favorable. I like this trade a lot. I think if we can get above this level right here, this previous little swing high, 1919, we're in really good shape. First target, and again, this is not a trade that is going to last several weeks. It might last a few days, maybe a week or so. First upside target, 1947, which is a simple, again, measurement of measuring A, projecting it from B. A measured move of 100% comes in at 1947. I think with the more robust and the realistic upside, it's probably closer to the 20 level. And again, like the last trade, Mike, purely technical. You could make the case that if equity markets get weak, emerging markets and emerging market currencies, although Mexico's not really an emerging market, they're more of a developed market, but certainly on the periphery, the argument would be, okay, S&Ps get weak, foreign markets, particularly developed and let's say, or less developed or emerging markets, those currencies tend to weaken. So you could make that argument, but that wasn't the fundamental reason to get into the trade for me. The fundamental reason was the technical.
Well, that's exactly what I was going to ask you is, it is dollar mex hires typically seen with risk off, that sort of thing, which fits with your S&P lower kind of bias right now. So that was my question. So you obviously look at charts and you look at all different charts across a number of, you probably have 25 different charts you could look at. Do you sometimes form an opinion, like for instance, I think the S&P is going to sell off, has the potential to sell off 5%. So I'm going to scour my markets to look for possible risk off setups. And so if it fits my mantra and it also has a good technical outlook, that's something I really want to put on? Or is it purely technical, completely just separate?
Well, no, the answer is somewhere in the middle. I think the one important point that I want to make, and again, it's important for me in the way that I approach markets, but I do think it's important. I think less is more, and meaning I don't look at that many markets. I look at the S&Ps, I look at 10-year notes, I keep an eye on gold, I keep an eye on oil, and I trade a handful of currency pairs. That's my world on a day-to-day basis, and that keeps me really focused and gives me the ability to kind of get intimate with the price action, which I think is really important. And, knowing Larry's background, I'm sure he would concur that if you're watching the same instruments day in, day out, you get into the rhythm, you develop a feel. And I think that's really, really important. The other point that you bring up that I think I can kind of touch upon here is that while I do tend to be a technically driven trader, Elliott wave practitioners have a tendency to let their view of the market cloud their ability to label the charts. So I try to be as objective as I can in terms of what's happening in the market. So am I looking at fundamentals? Am I looking at quantitative data? And the answer is yes, because it would be so easy, and you see it, and I'm not going to name any names of companies, but it's so easy for people to get overly bearish, let's say the stock market, and they'll label every single chart in a bearish manner because that's their view, right or wrong. I think it's really important to look at objectively at what's happening in the market overall, and if it's bullish, just label the charts in a bullish way or look for the setups that are bullish. Don't do it the other way around. Let the market's current state and projected future state reflect how you analyze your charts technically, not the other way around. And I think that's a really key point, which is why I'm saying, going back to the S&Ps, it's really easy for them. Well, let me rephrase that. It's why I'm not committed at this point yet to being overly bearish, because I know what the overall market dynamic is. The market dynamic for years now has been buy the dips after the dust settles and the shorts get their heads ripped off, or they get them, sliced off slowly by continually trying to pick a top here, pick a top there, and then they get run over. So I'm very aware that not much has changed overall in the economy. Economy remains strong, earnings remain strong. You guys know the narrative. But it's possible that we might have broken down technically, and we might still move lower, but that doesn't mean we're in a bear market. It just means that there's a correction lower. So I'm using what the overall narrative is at the time, which is still a bull market, still a strong economy, all that stuff. And I'm not trying to get too ahead of myself and try to be cute and clever by saying, okay, that was the top. Because I think that would be really, really hard to do. And if you're right, fantastic. But more times than not, you're going to be wrong, probably 9 times out of 10. And those aren't really odds that I like. So I'm just looking at it from the perspective of what is happening in the market and label my charts accordingly. So a very long-winded answer, but hopefully that clarified it.
Yeah, definitely. I was wondering, we're getting a question about the Aussie dollar. Can you pull up a chart of the Aussie and tell us, I know at certain points in the past you've been bearish. What are you thinking here, and what does it look like on the chart?
Yeah, I'm going to pull up a daily chart first. Again, obviously, it's been clearly bearish for a while right now. I have to say I don't have a terribly good feel in it here. If I had to, not had to, but, since I'm being asked to kind of make an assessment, I would say that this is clearly impulsive price action to the downside. This is clearly corrective due to all the overlap. So I would say, yeah, it's more than likely the next move is lower. Again, especially if the markets were to get weak, that would drive Aussie dollar lower. And if the US dollar moves higher, that would drive the Aussie dollar lower. The tricky part is, and this is what makes corrections so darn challenging, is you might be right on being bearish Aussie dollar in here, but prices could still rally up towards, let's say, 72.50. And we could still be in a situation where the next significant move is lower. So that's the problem. Yes, I think prices will move lower based on what I'm seeing right now, but that doesn't mean they don't go up here first before they move lower. And most of us, once you say, oh, I think we're going lower, we lock ourselves into that mindset that we are right, everybody else sees it, and we don't allow for the alternative view. And I don't mean alternative in terms of alternative wave count. So I think if you were going to be shorting Aussie dollar here, I would be scaling in. And I think you have to be really honest with yourself and say, unless I'm day trading, but if I'm trying to position for the next leg lower, let's say down towards 69.50 or lower, you got to really be putting your stop somewhere up in here, or you got to allow for that. Allow for that stop loss. If you want to put your stops here, which I know feels good because it's nice and close, it's only 20 or 30 pips away. That is a technical level that has absolutely no relevance. So if you get stopped out right there, it means nothing. It doesn't mean you were wrong because it's not a technically relevant level, in my opinion. So position size yourself accordingly so that you can have a stop loss that is more akin to 73, which is 170 pips away. But again, whether it's a 20 pip stop loss or 170 pip stop loss, it doesn't make a difference. Position size yourself accordingly, and you'll be risking the same amount of capital. Pretty basic.
What do you make of the fact that Aussie's been pretty unvolatile in this more volatile environment?
Well, unfortunately, that's kind of part and parcel for what FX markets are doing in general. FX markets have not had the benefit of the volatility that other markets have seen in 2018. FX markets, by and large, are still very quiet, very challenging. If you look at my performance year to date, nearly all of it is coming on the equities, futures, and options side. Yeah, we're making some money in FX, but it's definitely the more challenging market because we're not getting that volatility. Again, relatively speaking, yes, there's moves, but again, if you want to find the market that's trading, quote unquote, better, it's not the FX market for sure.
Why do you think that is with rates moving up in the U.S.? G10 really has not done a whole lot. You take a look at euro, dollar, yen, pound, Aussie. I mean, Aussie's had a decent move down, but emerging markets is where most of the move has been this year.
It's a great question, Mike. I'm sure there's a lot of people with a lot of different, rationale and theories on why that is. The one that I've heard that kind of makes sense is just, with heavy central bank intervention across the developed markets, that they say translates to, kind of goofy or let's say a compressed market volatility. Kind of makes sense, logically. When and if that changes, maybe that will be the change to the FX market. It does seem odd, though. It is the largest market by far in the world, yet it's the dullest, at least as of today, relatively speaking.
Yeah, it has been, and we've seen rates and FX typically move in terms of volatility. When one starts to get going, the other one does as well. But even in this last batch of rates excitement, FX has really been very quiet.
It really has, and much to my chagrin. I love to trade the FX markets, but it's all the more reason to remain flexible and kind of straddle asset classes, so to speak. But again, with the caveat of not spreading oneself too thin.
What about,
again,
I was going to say, sorry, one last chart. What about gold? Because that's a mix of a bit of everything. Gold is an interesting guy where sometimes it moves with the dollar, sometimes it's moving with rates, sometimes it's moving with risk, risk assets. We broke out through, we were in a range of 1190 to 1215-ish for a long time, and then we broke above it and we're holding. So what are your thoughts here?
Well, it's certainly encouraging. I'm just waiting for the chart to load here. Definitely having some computer issues this morning. It's certainly interesting. I mean, I've given up on trying to figure out why gold isn't moving higher despite what's happening economically, or at least I should say on a macro and a fundamental standpoint. Just a quick look. I still stick with my current wave count, which is we're probably in a wave 2 correction. This spike higher, very encouraging. So I'm using GLD here simply as the proxy. So as long as we remain above 114.88, I'm fairly encouraged. This obviously, again, if historical relationships are to be believed, if this were to continue, that would mean that the dollar moves lower. And again, that's certainly possible. But good God, trying to position oneself in gold has been a fool's game. And I think for me personally, until I get some more clarity, I'm really hesitant. I mean, we've had way too many of these breaks higher that look so damn good technically, and then you just get smacked in the face. Especially in February when we had that market sell-off. We started rallying before the markets got whacked in February, and then even in February and March, they just couldn't get above 129 or 129.20. But this is encouraging. Let's focus on what we have now. This is encouraging, but again, I'm a little guarded. Once bitten, twice shy for sure.
Yeah.
For me, if you did anything in here, I'd be nibbling small. If you are of the bullish gold opinion, or maybe I'm some long dated options, long dated call spreads, something like that.
Gotcha. All right. Well, thanks a lot. A lot of great information, great charts. Really appreciate you kind of taking us through the asset classes and showing us what you're seeing. Really appreciate it. Great information there. That's Dave Floyd, Aspen Trading. We'll speak with you hopefully next week.
Sounds good, Mike. Really appreciate it. Thanks for attending, everybody.